Welcome back, YouTube investors. Today, we're diving deep into the world of the restaurant industry, analyzing four of the most recognized names in the sector: Domino's Pizza Inc., McDonald's Corporation, Starbucks Corporation, and Texas Roadhouse Incorporated. These companies are giants in their field, each dominating their respective segments within the restaurant industry. But the big question remains: are these companies solid investments at their current valuations? To find out, we'll explore their financial metrics, profitability, dividend sustainability, and overall market performance. One of the key ways to assess a company's valuation is through the price-to-earnings ratio. This metric helps investors determine how much they are paying for each dollar of earnings. A lower P/E ratio can indicate an undervalued stock, while a higher P/E ratio suggests a premium valuation due to growth expectations. Domino's is currently trading at a P/E ratio of 26.79, which is below its 5-year average of 31.29, suggesting that it may be trading at a discount relative to its historical valuation. Meanwhile, its forward P/E ratio of 23.08 indicates that investors expect solid earnings growth in the coming years. McDonald's has a P/E ratio of 26.18, slightly below its 5-year average of 27.65, suggesting that the stock is fairly valued. Its forward P/E of 23.01 reinforces this outlook, reflecting steady expectations for future earnings. Starbucks, on the other hand, has a P/E ratio of 31.53, which is above its 5-year average of 29.48, indicating that it is currently trading at a premium. However, its forward P/E of 26.84 suggests a more reasonable valuation looking forward. Texas Roadhouse trades at a P/E ratio of 26.44, slightly lower than its 5-year average of 27.76. Its forward P/E of 21.78 suggests that the market expects strong earnings growth ahead. Beyond just P/E, the price-to-earnings growth ratio factors in expected earnings growth. A lower ratio often signals a stock that is fairly priced relative to its future growth. Domino's P/G ratio stands at 3.05, McDonald's at 3.40, Starbucks at 3.61, and Texas Roadhouse at 2.43. These numbers suggest that all four companies are trading at relatively high valuations compared to their expected growth rates, with Texas Roadhouse appearing the most attractive in this aspect. Insider ownership is another key indicator of management's confidence in the company's future. Texas Roadhouse leads with 0.56% insider ownership, followed by Domino's at 0.55%, Starbucks at 0.2%, and McDonald's at 0.03%. When it comes to profitability, return on assets, return on invested capital, and return on equity are critical measures. Texas Roadhouse leads in return on equity with 34.69%, indicating strong profitability, while the other three companies have not available the metric due to a negative equity because of negative retained. In terms of return on assets, Domino's shines with 32.61%, followed by McDonald's at 14.77%, Texas Roadhouse at 13.24%, and Starbucks at 11.52%. For return on invested capital, Domino's once again leads at 71.15%, followed by Starbucks at 28.26%, McDonald's at 24.19%, and Texas Roadhouse at 23.25%. Looking at share repurchases and dilution, Domino's has reduced its shares outstanding at a -4.51% compound annual growth rate over the last decade, McDonald's at -2.66%, Starbucks at -2.77%, while Texas Roadhouse has maintained a flat share count. Earnings per share is another crucial measure of financial performance. Domino's leads with an EPS of $16.69, followed by McDonald's at $11.73, Texas Roadhouse at $6.47, and Starbucks at $3.10. Over the next 5 years, Texas Roadhouse is expected to have the highest EPS growth rate at 10.88%, followed by Domino's at 8.79%, Starbucks at 8.74%, and McDonald's at 7.69%. While, when we look at free cash flow per share, which also plays a major role in evaluating financial strength, Texas Roadhouse boasts the highest growth in free cash flow per share at 22.65%, followed by Domino's, 13.39%, McDonald's, 6.38%, and Starbucks, 4.62%. For dividend investors, yields and growth rates provide insights into income potential. A higher dividend yield is attractive for income-seeking investors, while strong dividend growth suggests a company's ability to increase payouts over time. Starbucks has the highest initial dividend yield with a value of 2.66%, growing at 13.59%, and also the highest payout ratio with a free cash flow payout ratio over 100%. McDonald's yield is lower at 2.31% and also has grown at 7.36%, so less initial yield and expected growth but a more consistent dividend growth payer with less payout ratio. Domino's offers a 1.56% yield, growing rapidly at 19.29% with almost all the years growing at 20%, making it an attractive option for dividend growth investors. Finally, Texas Roadhouse stands out with a 1.59% yield, offering the lowest payout ratio and in spectacular growth during the last decade of 14.73%. In the graphic, the dividend for 2020 is calculated if the company had made the 4 payments during the year, but only did one. This is the reason for having only 5 years of consecutive dividend growth. Operating and profit margins are key indicators of efficiency. McDonald's stands out with an operating margin of 45.69% and a profit margin of 31.72%. Domino's follows with an operating margin of 18.71% and a profit margin of 12.41%. Starbucks maintains margins of 13.04% operating and 9.74% profit, while Texas Roadhouse has 10.16% operating and 8.07% profit margins. In terms of revenue and earnings growth over the last 8 years, Texas Roadhouse has demonstrated very strong performance, reflected in its stock price. Domino's and Starbucks have had positive evolutions but have underperformed compared to the restaurant ETF. McDonald's, despite flat revenue evolution, has outperformed the restaurant ETF in total returns. Debt levels are critical in assessing financial stability. Texas Roadhouse maintains the lowest debt/EBITDA ratio at 1.23, followed by Starbucks at 3.79, McDonald's at 3.72, and Domino's at 5.17. In terms of debt/FCF, Texas Roadhouse leads again at 2.14, with McDonald's at 7.78, Starbucks at 8.84, and Domino's at 10.16. Looking at market performance, over the past 52 weeks, Texas Roadhouse has delivered an impressive 10.73% price return, followed by McDonald's at 8.92%, Starbucks at 6.94%, and Domino's with a decline of -10.01%. While looking at market capitalization, what we can see is 2 of the biggest companies in the restaurant industry, and 2 mid-cap companies with a market cap value close to $10 billion. Now, let's talk about the crystal ball moment, analyst expectations and fair values. Analysts have set varying price targets for these companies over the next 12 months. Domino's has a price target of $487.24, representing an upside of 8.97% from its current price of $447.12. My fair value estimates Domino's at $443.75, suggesting it is close to fairly valued. McDonald's price target is $328.36, which represents an upside of 6.93% from its current price of $307.09. My fair value for McDonald's is $287.59, indicating it might be slightly overvalued. Starbucks' price target is $107.51, representing an upside of 10% from its current $97.73. My fair value for Starbucks is $85.21, which suggests it is overvalued at current levels. Texas Roadhouse's price target is $191.57, representing an upside of 12% from its current $171.05. My fair value for Texas Roadhouse is $174.97, indicating that it is fairly valued and could be a good investment opportunity. Each of these companies has distinct strengths and weaknesses. Investors should weigh these factors carefully when considering an investment in the restaurant sector. Let me know your thoughts in the comments, and don't forget to like, subscribe, and hit the notification bell for more financial insights. Until next time, happy investing!